Hey, good afternoon and welcome. My name is Matt Price. We have quite a few names still trickling in here as we get started. It's funny when markets are volatile, people seem to be more interested in some of the content that we put out. Randy said, never confuse it that they're more interested in actually what you're saying. They just want to know what is going on. So, with a few names still trickling in, on behalf of myself, Randy, Maddie, the rest of the Price Group, welcome. We have 8-10 slides or so prepared specifically on some of the market volatility and the tariff discussions that we've seen over the past few months. So with that, let's jump in. Quite a few clients on here who are familiar, a few new names as well. But Randy, he tries to tell you he's my older brother. He is actually my father. Myself, Maddie, make up the three partners, the advisors of the Price Group. We follow a fiduciary standard that we think is critical in this junction of managing money on behalf of families that we do serve. As many clients know, we have a niche in retirement. Over 80% of our clients are in fact retired. So we've really focused in on retirement as what we do and how we help. Randy and I, we've been humbled to have a number of awards from Forbes. Randy's gotten a number of awards from Barron's, Financial Times, etc. All three of us, Randy, Maddie, myself, are certified financial planners. Randy and I went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. That's a mouthful. Our firm, Steward Partners, based off the biblical definition of stewardship. And our custodian, Raymond James, has been a very good partner. That's where client assets are held. They run a very fiscally conservative operation, which we very much appreciate and take seriously, given the fact that's where client dollars are held weeks, nights, and holidays. So let's jump in here. First slide, uncertainty is elevated for the global economy. Not saying anything you probably don't already know, but just from a perspective of how uncertain, these are two different charts looking at the global economic policy uncertainty and then the trade policy uncertainty there on the right. And you see there's more trade policy uncertainty than there has ever been dating back to the 1960s. So you've heard a lot of CEOs come out and say we are less interested on if there are or are not tariffs, but we want some type of consistent communication so we can plan accordingly. So we'll talk in a minute here about what our thoughts are specifically on the tariffs, but uncertainty at record highs as it pertains to trade and also just global economic policy as well. This is a little bit of a busy chart, but this is an impact of the tariffs on economic growth and inflation. And if you can see there in the middle, what the analysts at Raymond James are forecasting is between a 7 and an 8% overall increase in tariffs. And remember that number. We'll talk about that here on the next slide of what that means to the gross domestic product or just the overall growth of America in general. But this is a good place to pause. We don't think these tariffs are long-term and stay in effect forever. We think this is more of a short-term negotiation tactic that the White House is using to try to get their way as it pertains to some foreign trade policy. The White House is under the impression that for a number of countries, we've been paying tariffs to other countries, and it has not been a two-way street. So what the Raymond James folks think, what we also think, is that they reach a place in the next 30, 60, 90 days, not sure exactly on the timing, and both countries look at each other and say, hey, why are we both paying tariffs to each other? Let's just cut them all together. So we think that's the outcome. We're less certain on the timing of that outcome, but we think that's the game of chess that President Trump and the White House are playing at this point. There's going to be some reciprocal tariffs early April. I'm sure you've seen or read about. And then I think it was yesterday or 2 days ago, the White House came out and said they might be a little more lenient on all reciprocal tariffs. There might be some caveats and exclusions to that, which the market found to be helpful with it moving higher over the past few days, absent today, that is. So I mentioned our forecast of that 7 to 8% increase on the tariffs. What does that mean to you? What does that mean to the economy? Well, this is what we have done is look back historically. Every 1% increase in the effective tariff rate, we think you could see a reduction in the GDP, or the gross domestic product, by a 0.1%. So let's just call it 7% of what we think the increase in the tariffs could potentially be in the short term. What that would equate to, using this calculation, would be the GDP, or the total American output, the economy would be maybe a better way to say it, would reduce by 0.7%. All in all, we don't think that pushes us into a recession. That would still leave positive growth for the country based on the current numbers, just at a slower rate than what we're currently experiencing. So, and then inflation, similar concept. Increase in inflation will also slow the growth. We'll talk about interest rates here in a moment and what we think for the rest of the year on that front. But so there is a potential negative effect on growth with tariffs, but once again, we don't think the tariffs are here long term. Tariff impact and the Federal Reserve and interest rates. What we said at the beginning of this year, we thought that interest rates were range bound, meaning we didn't think interest rates were going to go that much higher. We didn't think interest rates were going to go that much lower. And through the first 3 months of the year, that's what we have seen. Interest rates have moved down just a little bit, not a whole lot. We also said at the beginning of the year, we think there's probably 1 to 2 interest rate cuts by Mr. Powell and the Federal Reserve to reduce interest rates. That's more, think of those interest rates more of what your cash is yielding at the local bank, which it's probably close to zero, but maybe better said, what your money market with us is yielding. If there were 2 cuts of 0.25% each, that would be a reduction of 0.5% or 0.5% between now and Christmas. So no one's 100% sure, but that's at least our thought at this point. We had a client call end of last week and say, I'm starting to get used to these nice cash yields of 4+%. And our comment was talking about just this. We think there could be a slight reduction between now and the end of the year. But all in all, the 10-year U.S. government bond, that is the barometer for interest rates, really not in the U.S., but also it's used across the globe. That's yielding a little over 4%, 4.1, 4.2% currently. So we think that yield is pretty static for the rest of the year. We talked about, we think this is the proverbial clip the coupon type of bond environment, meaning you're going to get the income from your bonds or your fixed income, and probably not that much more as it pertains to maybe some tailwinds of price appreciation. And taking a step back, I'm sure a lot of clients are familiar. The bonds work kind of like the seesaw at your childhood playground. When interest rates go up, bond prices go down, and vice versa. So if and when interest rates do move lower, that will act as a tailwind to help some of those bonds appreciate more in the future. But for right now, we have a little bit of a benign or just kind of sideways look at where interest rates do go for the next 9 months. We titled this slide, There's Always Light at the End of the Tunnel. What we're looking at here is the S&P 500. That's the baby blue or the royal blue line, dating back to 1928. So almost 100 years worth of data here. And we have identified a lot of the events that spooked the stock market. You know, the crash of 1929, the first nuclear weapon, RFK was assassinated, the oil crisis in 73, Enron files for bankruptcy. You can read them all here. And, you know, my grandmother used to say, it's always something. And what she meant by that, there's always something to worry about. And we think that holds true here with investing in stocks. But the good news is, over the past, call it round numbers, 100 years, the stock market has climbed the proverbial wall of worry. So today, what we worry about are tariffs, geopolitical tensions still not only in the Middle East, but in Ukraine and Russia, et cetera. What's China thinking with Taiwan? Go down the list. But if it's not that, it's going to be something else. And as you can see, this is not a straight line. So we've done a number of blogs and thoughts on the market email here over the past month, talking about our thoughts on the market just with the increase in volatility. But volatility is the price you pay to create wealth in stocks over a long period of time. And I love this quote there on the right-hand side of the slide. A wise investor once said, "Never bet on the end of the world because it only happens once." So I like to say, if and when the end of the world does happen, we better abide by the GGG rule. You better have a gun, a garden, and some gold, because at that point, I'm not sure it really matters if you own stocks versus bonds versus cash. It's more of a function of who gets to HEB or your local grocery store first to try to stockpile the pantry. And I'd imagine in a scenario like that, a lot of people are trying to flee the city and get out to the country as a way of safety. But so we want to plan for the probable, not the possible. In the end of the world, the market falling 90%, that's possible. We don't think it's probable, so we're not planning for that at this point. The next slide here, we're looking, the title Time Heals. We think that is very appropriate for what we're looking at. We looked at the 4 worst times in history to start being a stock investor dating back to 1987, okay? So right before the 1987 crash, toward the end of 1999 or early 2000, before the dot-com bust, right before the financial crisis at the end of 2007, and then right before COVID, most recently in the spring of 2020, what happened if you put money to work at, quote, the wrong time? If you bought high? Well, what you can see here is even over these worst periods, over the past 40 years, you were still positive in the stock market by a pretty good margin, up 10.5% per year after the 87 crash, 7.7% per year after the dot-com bust, et cetera. Overall, we think it's not timing the market that matters, but it's time in the market. You've heard Warren Buffett and many other famous investors talk about that time and time again. We think those are wise words, sage counsel, especially when there is volatility in the market like we're seeing. In this slide, it's one of those things, it's easy to say, it can be hard to do. And what I mean by that is ignoring the noise of the media, just knowing that the media is not always your friend. They are there to get more eyeballs on their screen, on their newspaper, whatever form of media it is, so that they can sell advertisements at a higher dollar amount next month or next year. So what I wanted to point out specifically on this slide here on the left, you can see that it's not a straight line up and to the right. We have had a number of pullbacks over the last, call it 2.5 years of what we're looking at of data. The averages, when we look back to World War II, you're getting a 10% pullback about once a year, and you're getting almost a 20% pullback every 2 to 3 years. So overall, we think pullbacks are actually healthy. It gets some of that excess speculation out of the market, which we have seen. So with that being said, we don't see this as the market is falling apart type of situation or scenario. We don't know what we don't know, meaning there could be some type of black swan event that we are unaware of that happens overnight. But absent something of that nature, based on some of the economic indicators that we do follow, we don't see the market just crumbling here in the short term. And then maybe a catchy title of this slide, maybe it's not, don't sleep on dividends. What we're looking at here is the return of the overall stock market since the end of 1992. And what we can see is how much the dividends actually participated in the total return of the stock market. And it's a quite astounding figure. It's almost half, almost 50% of the total return of the stock market has come from dividends. So clients are probably very familiar. We're big believers in dividend paying stocks. For those that are new, we think that is one of our secret sauces. We have a number of different dividend stock investment strategies that we utilize for clients. But in an environment like this that is more volatile, where the market could just be choppy for a longer period of time, dividends are really your friend. Even if the stock market moves sideways between now and the end of the year, you're still going to be collecting those dividend payments quarter over quarter for each of the companies that you own. So we think this type of environment is actually when dividend stocks tend to do the best, where the stocks that we own historically have had a lower risk budget when compared to the overall market, and also producing more income when compared to the overall market. And then another Warren Buffett quote here, be greedy when others are fearful. We're looking at a 15% plus drop in the S&P 500, or the stock market, on the left, and then 20% drop in the S&P 500 on the right. Now, we have not got to that 15% reduction in stock market prices. The stock market peaked in the middle of December or so, and a few weeks back, we got down to just right around that 10% pullback. So we got about 2/3 of the way to that 15% pullback that the data is suggesting here. But the point we want to make is this: look at each of these numbers, and let's look specifically at the 15% pullback, since that's the one closer to what we have experienced over the past month or so. And with these pullbacks over the next year after the market bottomed, the market's up on average a little over 25%. So we're not whispering in your ear saying that's exactly what's going to happen this time. History does not repeat itself, but it often does rhyme. And so with that being said, when the market does have a pullback, typically the next 6-12 months have been positive to recoup some of that downside that you did experience. So long-term investing, it can be fun. It can be not so fun. I'd say the last few weeks have been in the not so fun camp, just with the market moving lower. Sometimes clients will tell us, well, I just really don't like that volatility. And Randy has one of his funny, I'd say, dad jokes, maybe grandfather jokes, where he'll say, well, not so quick. I think you actually do like volatility. You just like the upside volatility. Where in 2023, with the market up big, we didn't get any calls saying, Matt, Randy, Maddie, y'all are taking too much risk. My portfolio's up too much. And he says it tongue in cheek. But so clients really don't like the downside volatility. And we understand that, but having an investment process is so critically important in periods like this. And just as way of review, the dividend stocks that we're focusing on are not only companies that pay dividends, but historically have increased their dividends year over year. And there's a lot of things downstream of companies that can increase their dividends year over year. That typically means more free cash flow. That means a solid balance sheet. That typically means the companies are larger by stature, revenue growth, go down the list. And so that's really what we're focused on. That's number one. Point number two is, this is the beauty of having a live well plan in retirement. So we don't know necessarily the timing of market pullbacks, but we've planned for these pullbacks within each client's live well plan. And we do that through what we call the Monte Carlo simulation, to where we are actually showing clients going through retirement 1,000 times and randomizing their returns, using down years, having up years, having sideways years. But we have taken into account down years when we're planning for the duration of your retirement. So we like to say the downturn doesn't catch us by surprise. The timing of the downturn is what catches us by surprise sometimes. But it could be a good time to review your Live Well plan. If that is of interest, let us know. And we would love to roll up our sleeves and take another look at that if it's been more than 6-9 months or so since we last looked at it. So with that being said, those are our prepared remarks. If there are any questions or comments, feel free to give us a call, shoot us an email, and we would love to catch up here in the short term. So from Randy, myself, Maddie, the rest of the Price Group, thank you, and we will look forward to catching up soon, like I said. Take care. Thank you.